Mark Strand's presentation to Maria Ruiz. Hello, Maria. It's good to see you again, and I want to thank you for coming to our offices today. When we got together a few weeks ago, you indicated at that time that you wanted to better understand your finances, and we indicated that we could help you with that through a comprehensive financial plan. At that time, you also indicated that you had several goals that you wanted to achieve by doing this financial review. And I just wanted to briefly review those. First, you wanted to make sure that you and Sancho are on track to retire in about 15 years when you're 65 and he's 67. You want to make sure that you're protected if something happens to Sancho unexpectedly, either an untimely death or a disability. Third, you also wanted to make sure that your income and expenses are on track. And finally, you asked us just to provide you with other ideas that might smooth out your financial lives. So we are happy to do that. We have put together a very, we think, comprehensive plan for you. And I want to thank you for providing the significant amount of information you did and being so open and candid with us. I've got a few slides. I'm going to go ahead and step around here and so I can show you the different slides here. And you'll see the first one kind of breaks out your assets and liabilities. And the left-hand corner there has got assets, right-hand corner's got liabilities, and the bottom center has assets versus total liabilities. You can see your distribution of assets is fairly nicely divided. You've got a fairly significant amount of investment assets, you've got real estate here, and then you've got a fairly significant amount of retirement. Your liabilities, you've got a large amount in real estate debt, and then you've got a large piece of credit card debt that is a concern to us, but something we're going to discuss with you. And then finally, the bottom pie chart you can see has your total assets versus total liabilities. That's a fairly nice distribution, 71% assets versus 29% liabilities. But we do have a couple of concerns. We do run ratios when we're looking at clients' finances, and did notice that your debt ratio is a little bit high, and your debt to income ratio is a little bit high. Those are just things that give us some indicators on how we can help you. And so the next slide you'll see dedicated versus discretionary expenses. Dedicated expenses are basically just expenses that you have to pay on a monthly basis, don't really have much of a choice. Mortgage payments, the electric bill, water, utilities, cell phone bill, that sort of thing. The discretionary expenses are more of what you would think they would be: travel, entertainment, dining out, that sort of thing. The allocation of income at the bottom there, you see three different pieces: the dedicated and the discretionary, which we already discussed, and then there's this other little pie here, which actually isn't so small, 10%, your discretionary cash flow and unallocated savings. That's actually where we're gonna that's income that you have that we can use for some solutions for you, and that's a pretty nice piece of the pie, so to speak. So looking forward to sharing with you what we can do with that. Go to the first recommendation slide. These are basically, we put these in order of kind of the chapters that we reviewed for you. And the first one was looking at your income and expenses and your overall balance sheet, looking at your financial statements. And you'll see you'll see each recommendation according to the chapters in the plan. But at the end, we actually rank each of these recommendations, ones that you should start working on right away, and then kind of stair step down from there. So The first one that we had within the financial analysis, though, financial statement analysis, was to refinance your mortgages. And you can see that you've got three mortgages right now that we would recommend be refinanced to 15-year loans. And given the interest rate environment we're in, very low interest rate environment, you can get 4.8% rates on those right now. And then we also recommend refinancing that home equity loan with another 10-year loan. Now, in the case of the three mortgages, those are going to, like I said, end around the time you all are ready to retire. The home equity is actually adding a couple years to your loan. You've got 8 years left right now, you'll have 10, but it'll still be well in advance of your retirement date, and that rate is just hard to argue with. So we know that you work with Jennifer Patterson at ABC State Bank. I've, at your request, visited with her already, and she is ready to start putting that together. I will say there is a fairly significant amount of closing costs that will have to be paid to the tune of about between $35,000 and $40,000. But I will assure you that is money well spent, and we have a recommendation on how to pay for that. We also want to talk about paying off your credit card debt. Those rates, compared to even your current mortgage rates, are significantly higher. And in fact, I'm just going to read off these rates right now. You've got one at 14.5%, one at 13.9%, one at 18%, one at 23.9%, and one at 19%. And we've also included the furniture loan in with the credit cards. There's very little chance that we would be able to consistently invest your money and get those kind of returns. And so it's our recommendation that you go ahead and pay these off as soon as reasonably possible. And when I say reasonable, we're looking at about 2 years, 25 months to get those paid off. And how we recommend that be done is you go ahead and continue making your regular monthly payments, which comes out to about $3,500. And then we're going to encourage you to go ahead and add an additional $5,200 to pay on the principal of those loans. You're going to go ahead and start paying the principal towards the one with the highest interest rate, which is that 23.9, and essentially it's going to create a snowball effect. Once that one is paid off, you'll take all the money that you were putting towards that one debt and move it to the next debt with the second largest interest rate, and you'll do that until all of the debt is paid off. Total debt of $180,000, and within 2 years we expect that can be 2 years and 1 month. We expect that can be paid off. Okay, next we're going to go to the tax section chapter, and just had one thought here. We looked at your current tax situation, and we had a hunch that the FICA was out of line. We're paying about $54,000 into that, and this was all related to Sancho's employer. We recommend that be dropped down, and he can visit with his HR department about that. The amount that we projected that he really needed to have paid in was about $47,000. So have him visit with them and have that adjusted. And if he needs any help with that, we're happy to visit with them or with him. The next chapter is life insurance, and I know that you currently do not have any life insurance on you. Sancho has several $1 million of insurance on his life, but we still actually think there's more need there. And in Sancho's case, it's about 3.7 million. If something were to happen to him unexpectedly, there would be a fairly significant cut in your income, and we certainly don't want that to happen. We think that 3.7 purchased with what is called level term insurance would be adequate for your needs. We also think that it would be helpful for him to have insurance on you as well, and so we're recommending $1.3 million, and we think that should be done within the next 30 days. And you know, if you not sure about your insurance agent, if you need a referral there, we'll be happy to provide you with 3 names. That's typically what we do. Yeah, and then you select the one that makes the most sense for you. Next, we looked at the long-term disability, and this is another pretty big concern from our perspective. This insurance, you know, if something were to happen to Sancho where he is not able to work, there could be a fairly significant drop-off in your income again. And this number is going to be a little surprising, but it's probably just about $36,000 a month. He does have a small $60,000 a year. It would cover $60,000 in expenses a year, but we are recommending that number be bumped up. It's going to be a fairly expensive policy, and I would encourage you to shop around a little bit, but we think that could be around $24,000 a year. The long-term care, I'm not going to spend much time on that. That is not something we think you need at this time. It's something we're happy to revisit with you on an annual basis, but based on your net worth, it's really for somebody that has a lower net worth than you do. So on to the health insurance. Currently you have a good indemnity policy. It's quite expensive. We've recommended that you can do 2 things in tandem here. During his next open enrollment period, we recommend you open an HDHP, which is a high deductible health plan offered through his employer. And then at the same time, that allows you to open a health savings account, or HSA. And the HSA works kind of like a savings or investment account. You're able to put in, before taxes, up to $7,000 a year currently, and that'll likely go up with inflation. And that money can be invested just like a mutual fund account, and allow you to have some growth there. And you can, like I said, look at it as another savings account or investment account. Next, we looked at your home, auto, and other policies, and have just a few brief recommendations there. We do recommend that you increase your limits on your auto, that you put some insurance on your boat, and that you increase your umbrella policy. Right now, you've got about $1 million. You have $1 million policy on your umbrella. That is awfully low, and with you increasing your auto limits, you're probably going to have to increase your umbrella policy anyway, just due to your net worth. So we're increasing it. We're recommending that be increased by $4 million. Cost to you on that is pretty, nominal compared to some of the other things, but definitely well worth reducing liability. We also recommend obtaining some floaters for your floaters, or what we call riders, on your home policy as well, and those will protect a lot of the significant tangible assets you have. You and Sancho have some nice artwork, you have some fine jewelry, he has some coins and stamps and some sports equipment. Those definitely need to be protected with additional insurance. We also go into the next slide here. Want you to think about your kind of immediate needs, and I think this will resonate with you in a significant way. Currently, you've got about a little under $70,000 in cash, and if an emergency came up that required more than that, you might need to liquidate some assets that could be untimely for your portfolios. So we're recommending that you go ahead and reallocate over the next 3 years one of your brokerage accounts, deposits, $36,000 plus some unallocated savings for a total of $50,000 per year, and until you get up to a reasonable amount of cash that's on hand should an emergency take place. Next slide, we're looking at your IRA. I'm not going to spend a lot of time on that. You had indicated that you might have interest in us managing your IRA, and we would be happy to do that, and I would be more than happy to introduce you to our investment team. The cost for that is 1% for anything below $1 million, plus a $75 a year custodial fee for the custodial account. And if additional assets are added to the relationship, there's a stair step down from there to reduce expenses. Next slide, continuing on with the IRA, but focusing back on specific things that can help you immediately. We do recommend that you go ahead and increase your contribution to your existing IRA. Right now you're putting in $6,500 a year. You can actually increase that based on your age to $7,000 a year, and that will probably increase again with inflation over the years. But for now, we go ahead and ask that you increase that by $500. Also, Sancho is significantly under what he could allocate to his 401k. He could allocate almost $17,000 more than he's allocating right now, and that would be deposited into an account that would grow tax-free, which would be beneficial to both of you. We've also looked at your estate planning, and we recommend that you and Sancho have your documents updated within a reasonable period of time. You have existing wills right now, and you know, if one passes, all assets move to the other, and if the other passes, all assets move to the first. So, and that's great that you have that in place, but we would also recommend, because you've got real estate outside of the state where you live, we would recommend that you have a living trust in place. We also recommend advanced directives and medical powers of attorney for both of you should something unexpected happen. That can run you, several $1,000s. We think $5,000 to $6,000. We do recommend that you visit with a board-certified estate planning attorney. A lot of different attorneys out there, just like doctors, and there are specialists that assist with specifically with estate planning. So we would be happy to refer you to somebody if you don't already have somebody that you would like to work with there. In addition, the next goal, we want to make sure that you verify the beneficiaries that are in place on your various accounts, including IRAs, insurance policies, 401ks, that sort of thing. Make sure that you've got the proper beneficiaries in place, who you want that money to go to. And maybe Sancho, maybe Manuel, whatever the case, we want to make sure that that's in place. And then finally, I want to make one last recommendation. We want you to consider writing a final letter of instruction. This will go along with your will. That will kind of give your executor an idea of personal desires and requests that you have. It shouldn't take long to do relative to your estate plan, but it's it's well worth it, and it just makes sure that your personal wishes and desires are going to be accounted for, because sometimes the legal documents can become a bit formal. Okay, finally, I'm going to sit back down here and want to thank you for listening to me today, and did have one last couple of slides here, 2 slides. We went ahead and ranked the recommendations, and you can see we think increasing the balances in your savings is important. Adjusting the FICA, that could be done quickly. Purchasing the insurance, the life insurance, obtaining long-term disability, increasing liability limits on the car, adding liability insurance to the boat, and increasing that umbrella policy. Contributing to your IRA and to Sancho's 401k, those are kind of in tandem. Putting new estate documents in place, writing that final letter of instruction, verifying that the primary and contingent beneficiaries are in place, paying off the credit cards and furniture loan, refinancing the mortgages. Sancho should move to that high deductible health plan as soon as he can, and then open that HSA. You get those riders in place on the personal property. Move your IRA, if you want to us, for us to manage. And then we'll look at the long-term care in future years. Again, I want to thank you for coming in to visit with us today, and we look forward to a long and fruitful relationship with you. If there are questions along the way, do not hesitate to call me or any one of our advisors, and we will make sure that your concerns are addressed. Thank you, Maria. Have a good day. Bye.